Good morning, everybody, and welcome to webinar on basics of commodity derivatives. My name is Ramesh Varkhedkar. I head commodities and currencies at ICICI Securities. Today we have Somesh Vaidya with us from MCX, who will run through the presentation on commodities, which are traded on MCX. Over to you, Somesh.
Very good morning, everybody. And a big thank you to every one of you to be present out here this Saturday morning, and a big thank you to ICICI team for organizing this webinar. So if you are a new investor in commodities, or you are an existing investor to commodities, or you want to learn more about commodities, such sort of forums are extremely important for you, for us to pass on the knowledge of what commodity derivatives are. When we talk about investments, we clearly know we have fixed deposits, we have mutual funds, we have the small savings schemes as investments. But when we want to grow our wealth, it is extremely important to know what asset classes are available for you all to put your money in. So with this quick background, I, Somesh Vaidya, Business Development Officer at MCX, will share with you a short presentation on what are the commodity derivatives that are traded on exchange, number one, and how you can take advantage of these products into your trading and investment portfolio, which will help you, maximize your investment returns. So I'll share a small presentation for maybe 15-20 minutes. And if you have any questions at the end of the presentation, we'll be happy to take it forward. Thank you so much. I'm sharing my presentation with you all. So as we all know that when we talk about financial markets in India, capital market or share bazaar as commonly spoken about is the most dominant market in India. But overall financial market consists of 5 different markets: the capital market, the debt market, the forex market, commodities market, and the money market. Now, if you see these 5 markets and we try to study these markets a bit deeply, what we would understand is that each and every market are interlinked to each other. Take example of forex market. Any changes in interest rate has an impact on commodities market. For example, the crude oil. The crude oil in the international markets went up from 60, 70 odd dollars till $100, $140 some time ago. And prices of commodity increased, but the rupee also jumped from 75 to 75, 50, 76, right? So what happened is any commodity which India imports, the cost of import increases. So that's the impact of forex market. Money market is how much liquidity is there in the market. More the liquidity will flow through an easier, cheaper asset class. Debt market, market for interest rates, market for bonds. Any change in debt markets has an impact on forex as well as commodities market. And when we talk about commodity market per se, commodities market gives signals of what is happening in the economy, what are the demand supply scenarios of commodities which every single person of us consume or is exposed to. And any shares or any company which is exposed to such commodities has a direct impact of changes in prices. Take an example of any manufacturing company which is extremely heavily dependent on metals. So any change in price of metals is going to impact the share price, because with increasing commodity prices, it's going to impact the raw material cost. So is the cost of goods sold and eventually the price of the finished product, right? So commodities market gives signals to each and every investor about the status of the economy, what's happening in the market. And accordingly, you can take an informed decision in commodities market as well as in capital market, where to diversify your funds. So when we talk about our platform or a market institution, these are the 4 pillars of the market. One, the platform itself. So when we talk about platform, the commodities market trade and extended hours as compared to the equity markets. It starts at 9 a.m. and it runs till 11:30 or 11:55 p.m. in the night. So first question that would come into your mind is, what's the need of such extended hours? Very simple. India is price taker of most of the commodities traded in international markets. For example, gold, for example, silver, natural gas, crude oil. What do you mean by price taker? We do not have enough production. As a result, we do not have a say in pricing of that commodity, right? Thus, to have an arm's length price with respect to international benchmark commodity contracts, we have to keep our markets open till extended hours. But when we talk about agricultural commodities, because those are the localized price discovered contract, those contracts are available for trading from 9 a.m. till 5 p.m. in the evening. So I offered a platform, then I need to give products. So what are the products available for trading on commodity derivatives platform or MCX? So we have futures, we have options and futures, and we have index futures. We will discuss a bit about these products in a little later. So we have products, we have participants, we have platform, we have products. What we need is participants. So participants in commodity markets could be the day traders who would like to take advantage of the volatility of underlying commodity. Hedgers, the actual users of commodities who are exposed to the price risk. There are smart traders called arbitrageurs who would like to take advantage of price changes between two markets. And ultimately, a farmer producing organization or a farmer who wants to come and sell its produce through the exchange platform, thereby having a better price realization, right? So participants are extremely important. Last is the policy or the regulatory developments for overall growth of the market. So when we talk about policy changes, when SEBI took over the aegis from the erstwhile FMC, the first product that they allowed was options and futures. Then they allowed index futures. Then very soon you would see foreign participants would be allowed to trade in commodities. So gradually, like a child grows every year, this market was started in 2003. So it's a 17, 18-year young market. So as and when, with the experience that the regulator is having, we are able to see more and more products and participants to be allowed to take exposure into commodities. So these are the four basic pillars of any market for participants to come and take advantage of. So what are the commodities that are available for trading in the market? As per the regulator, they have notified 91 commodities in which the exchange may launch derivative contracts. Now, what do you mean by derivative contracts? Futures of underlying commodities and options on futures of the underlying commodities, right? So we trade derivative contracts. We trade contracts which derives its price from the underlying commodities, the changes in prices of the underlying commodities. So broadly, we have bifurcated into four parts. So we have bullion products, which is gold and silver. We have base metal products or metals and alloys, as we say, which trades aluminum, copper, lead, nickel, zinc, steel, brass, etc. We have energy products like crude oil and natural gas, and very soon electricity, where you are sitting in your room right now. We use electricity extensively. So exchange is also working on electricity derivative contracts. And then we have agricultural commodities, which are also available for trading. So if you see or deeply take a look, each and every commodity which I have shown in the screen, we as an individual are exposed to it. India consumes the largest gold and silver, right? As far as aluminum is concerned, we use aluminum products, we use base metal products. Energy, crude oil and natural gas is used by industries and used by individuals for their consumption. Agricultural commodities, we consume it on daily basis, which means that we are already exposed to these commodities. The only differential is that we are the consumers. Ultimately, whatever the price is, we have to take it. But what if same products which we are exposed to on a daily basis is available for you as an investment, right? You know, based on the research, based on the studies by ICICI Securities, you can easily put in your money in any of these products, taking advantage of price movements. So when we talk about participants, generally, on one hand, we have hedgers like the corporates, the farmers, the producer consumers, the intermediaries in the spot markets, the merchandisers, the importer exporters, the eligible foreign entities, hedgers, as we say, these are all on one side of the product. So these are the actual hedgers. They transfer the price risk to investors, to speculators, to the arbitragers, and the new set of participants like the alternative investment funds, the mutual funds, the PMS, portfolio service providers, etc., etc. So it is extremely important that all set of market participants are there for a healthy liquidity in the contract. On a regulatory front, SEBI is the regulator of the exchange. We are a market infrastructure institution, stock exchanges having commodity derivatives segment, wherein we offer new commodity derivative products. The members of the exchange are registered with us, just like ICICI Securities as a member is registered with us, and you as client register yourself with the broker. So if you see the hierarchy, pretty simple. Each and every step, the member, the institution is a self-regulatory organization. Most important slide across my presentation is basically what affects the price of commodity markets. Now, you would be exposed to direct equity markets, right? You put in money into direct shares of the company, and any changes in prices have some reasons. Maybe the company has got a good order, or company has performed better in terms of financials, so on and so forth. And as a result of which, the price of the share increases and your value, your capital increases, right? But when we talk about commodities market, what we need to understand is that it has impact from not only couple of or financial numbers, but many factors play into changes in price of the commodities. Most important is price ruling in the international markets. Since India is a consumer-driven country, an import-driven country, whatever are the prices of basic commodities in the international markets, we have to accept it. Example is crude oil, natural gas, gold, silver, right? All these commodities India imports. As a result of which, any changes in prices has an impact of change in price in the Indian market. Forex rate, I explained in the second slide that how changes in the rupee dollar ratio impacts the price of commodity. Any appreciation or depreciation in dollar in terms of rupees, it impacts the price of the commodities. Geopolitical factors, I mean, from last 40-45 days, each and every one of you would have seen about the Russia invasion of Ukraine and its impact on the global as well as the Indian scenario, right? What happened is the Russia supposed to be the largest exporter of energy products, largest exporter of metal products, and it had an impact on all the commodity prices world over, right? So geopolitical factors play an extremely important role in deciding and driving the price of commodities. Then we have trade policies and regulations. Then we have economic factors, very, very important. Take a scenario 2 years ago when we had first lockdown. Everything was shut except for the essentials that we stocked up. We stocked up food items, we stocked up medicines, and etc., etc. But as and when the market started to open, we saw consumption picking up in the market, the demand for commodities picking up, and as a result of which, each and every commodity prices had seen a fantastic growth or price increase based on the demand and supply scenario. So economic factors in the country play an extremely important role. If anybody would have heard yesterday's RBI policy decisions, they also mentioned about increasing commodity prices of agricultural as well as prices of metals and crude oil, right? So this shows that even the regulators are closely watching these factors, because any increase in price of commodities, which means we are talking about inflation. Exactly, right? So economic factors also play an extremely important role in deciding what would be the price of commodities. Trends in fast-growing economies like India, since the consumption increases, the price of the commodity is bound to increase, because when we have an equal demand supply scenario and we have short of supply and a lot of demand, the price is going to increase. And then we have specific commodity level statistical release like inventory levels of commodities, which decides what's the price of what would be the price of that commodity. So take example of cotton, the shirts that we wear, the clothes that we wear, right? From last 6 months, the price of cottons have more than doubled from 18,000 per bale with the start of season October last year. Today in April, it's around 44,000 a bale. Why? Because there was a scenario where there was no inventory of the last year. The production was impacted and demand is really good and there is a short of supply. As a result of which we had seen prices of commodity like cotton increase by 2 times. So these are the factors which really impact the price of commodities. When we talk about MCX, gold and silver contribute around 56% of the total turnover of the exchange, followed by crude oil and natural gas. So 80% of the volumes of the exchange is contributed by 4 products: gold, silver in bullion segment, and natural gas and crude oil in the energy segment. And then remaining 20% is contributed by base metals and other agri products. So why would anybody want to trade commodities, right? What is the use? I mean, I put in my money in mutual funds and direct equity and so on and so forth. Why there is a need to put my money to trade commodities, right? I don't understand commodities. It's very simple for me. Ek bari paisa dal diya and I'm done with it, right? But there is a case which proves that having a small exposure to commodities does help in balancing your portfolio in times of volatility. So leverage is most important. I'll go to the next slide before explaining you what do you mean by leverage. So leverage is basically the margin money that you pay to trade commodity derivatives. Liquidity is the most important aspect of a market institution platform. If the contract is liquid enough, having equal number of buyers and sellers, it makes a sense or a point for me to put my money in so that there is an easy entry and exit. A case for diversification, which I'll explain later on a different slide. Hedge against inflation. That's what I was talking about in previous slide, that increase in price of commodities, we talk about inflation. So does commodity derivatives help if I take buy positions on the contracts? Yes, for those commodities which are part of the inflation portfolio, any exposure to commodities will help you diversify your inflation risk. And transparency. Transparency means you do not know when you buy or sell who is the counterparty, right? It's multiple buyers and multiple sellers. So there is an easy entry and exit available with exchange, clearing corporation, taking novation of each and every trade, taking guarantee of each and every trade. So it is extremely important for you all to understand that these are the 5 important factors which makes a point for you to come and start participating in commodities. So by leverage is the margin money that you pay for trading one lot of commodity contract. So we have gold petal, which is a 1 gram contract having margin requirement of roughly 400. Descending order of small to large. I have, ascending order. You can see that you can trade gold petal with as low as 400 rupee margin requirement instead for a contract value of roughly 5,145. Then we have silver micro contract, which is a 1 kg contract where margin requirements is 7,500 rupees. Taking an exposure to 1 kg silver contract with value of around 67,000 rupees, right? Then we have gold guinea, gold mini, silver mini, the bulldex, the index basically comprised of gold and silver with requirement of 50,000 rupees. So you can see that for different set of investors, there are different products available for you to trade. If there is a seasoned investor or a trader who understands in gold and silver easily, he can even trade gold 1 kg contract having margin requirement of roughly 4 lakh rupees. Take example of nickel. Because of the price volatility post the war, the margin requirements have shot up to 50%, which is 18 lakh rupees, right? So for every kind of investor, there is a product available from the smallest of the margin requirements to the largest of the margin requirements. Now, this is an example of diversification. We took a 5-year study and we found out that whenever there is an easy access to money available, liquidity available, people start putting money in the capital markets, and as a result of which the gold does not shine much. But whenever there is a scenario, geopolitical tension or increase in interest rate by the US government or any high inflation scenario in the country or the world over, the requirement for a safe haven investment increases, as a result of which people start putting their money in gold contracts. But again, when market scenario normalizes, we see money coming back into the capital market. So we cannot pretend, or we cannot assume what is going to happen in future. But if you have a portfolio comprising of shares and gold both put together, in a scenario, in a circumstance where you don't know what's going to happen in future, gold is one asset class which will help you balance your portfolio. So these are the three scenarios over the last 5 years which have aptly proven that gold is a must-have in everybody's portfolio to make and balance out the volatility in the market. So what are the gold products available on the exchange platform? So we have the gold petal contract. From left to right, I'm discussing, sorry, the gold 1 kg contract, which is the largest contract on the exchange, followed by gold mini, which is a 100-gram contract, gold guinea, which is an 8-gram contract, and gold petal, which is the 1-gram contract. So you can see how the prices of gold, silver have shot up in over the past few years, and you can also see the volatility numbers on the extreme right-hand corner. So you could easily and fairly understand why gold is so closely associated tradable product for investors. For silver, we have 30 kg contract, 1 kg contract, and 5 kg contract. The 30 kg contract, every 1 rupee the tick change is 30 rupees. For a 5 kg contract, it's a 5 rupee tick movement, and for 1 kg contract, it is 1 rupee tick movement. And you can see the volatility figures by yourself. The silver is considered to be more volatile as compared to the gold products, because silver has got a lot of industrial demand in itself. When we talk about energy products, we have two largely traded contracts. One is the crude oil and one is the natural gas. These both contracts are aligned to international CME contracts, as a result of which both these contracts are cash settled. They expire similar way, in similar fashion as expired in the NYMEX. So we have a crude oil 100-barrel contract with 1 rupee as tick size, which means for every 1 rupee change, you either gain or lose 100 rupee. Then we have a natural gas contract with 1250 million British thermal unit as the trading lot, with 0.1, that is 10 paisa tick size, which means for every 1 tick change or a 10 paisa change, you make or lose 125 rupees. And these are the cash settled contracts. Now look at the extreme right-hand side table, the volatility for the last year. It's 21, not 2020. It's 94% and 67% in case of crude oil and natural gas. And if you extrapolate these numbers with current times, I'm sure the numbers would be extremely high, right? Because of the geopolitical tensions that we saw. So these two are the most tradable and the most volatile products on the exchange platform. Then we have aluminum, zinc, lead, nickel, and copper as 5 base metal products, each having its own set of reasons for price volatility, with last 1 year seeing the largest price movement in all the base metal contracts because of the price of, there's a demand, there is a short supply of these products, and we have seen price increase in this 5 base metals. So our aluminum contract is a 5 metric ton contract with tick size of 0.05, which means for every 5 paisa tick change, 250 rupees will be the profit or loss on 1 single tick. Copper, it's a 2.5 ton contract, and 0.5 is the tick size. Lead, a 5 ton contract, again a 5 paisa tick size. Nickel, 1.5 ton contract, 10 paisa tick size. And zinc is a 5 ton contract with 0.05 rupee or 5 paisa as the tick size. With every tick movement, we have shown you what is the price change. Now, last day of the month is the expiry day of that contract, and the delivery logic is compulsory, which means last 5 days, if anybody is standing in the market, it gets into delivery mode. But then for an investor who wants to just take view on the price before the start of the delivery period, the broker tries to ensure that the position is rolled over to the next liquid month. So just an example to showcase how these base metal products or any commodity, to say so, is exposed to the Indian economy. Take example of aluminum. It's exposed the transportation industry, the electrical industry, the construction, the machinery equipment, packaging, consumer durables, electric vehicles, battery manufacturing, so on and so forth, right? So all these industry participants are exposed to price risk of aluminum. Lead, 80% is used in batteries and then remaining 20% in other products. Copper, building construction, electrical and electronic products, transport equipment, so on and so forth. Nickel, used in engineering, construction, metal goods, appliances, etc., etc. So is zinc used maximum in galvanizing, die casting, and so forth, right? The point I'm trying to make out is that these are the actual commodities being consumed by the market participants for running the economy, running the activities of the economy. So any price change of these commodities is going to impact those companies, as a result of which these companies to be exchanged is their price risk, right? And we as an investors having informed decision can take advantage of the price movements. Briefly, we'll touch upon what are options on futures. So each and every one of knows, if not, then options act like an insurance against the adverse price movement. For buyers of options, they are in the advantage because their loss is limited to the premium that is paid by the buyer to the seller. The seller typically knows the writer of the option. It's zero or free from the counterparty risk because once you pay the premium, that's the maximum loss that you can expect. It's unlike futures where the ratio is 1:1. So every price change of 1 rupee, you make or lose 100 rupee. But in case of options, it's the premium amount that you pay and you are done with your investment, or you're done with your maximum loss that you could suffer, right? Beyond that, whatever is the price movement of underlying, you do not make further losses. The profits are unlimited, but the losses are capped to the premium amount that you have paid. Since it's a one-time premium payment product, a smallest premium that is made ensures a low cash flow, right? Having a low capital requirement, low transaction cost requirement, because the transaction cost is calculated in the premium amount and not on the value of the product or the contract. So option buyer, basically he has got the right to buy. The option seller, or when you buy a put, is the obligation to sell. But as a buyer, you pay premium since you have a right to buy in case of call option. And again, when you buy a put option, you pay premium and you have right to sell. In case of option seller, he collects the premium what buyer pays, and he has got an obligation. So the risk of an option seller is much higher as compared to the option buyer. So what are the products available for trading on the exchange platform? So we have gold 1 kg product, silver 30 kg and silver 5 kg options on future. We have crude oil, which is a 100-barrel contract, which is available for trading and which is the most liquid option product available on the exchange platform. We have copper, we have zinc, and we have nickel options. And last January, we launched options on natural gas, again, very liquid, cash settled option products available for trading on the exchange platform. So these are some technical aspects which I'm not going to cover today. Maybe at a later date, when you start trading options, we'll be able to discuss more on this. So these are some Greeks which has an impact of change in the option prices. Then third product which we discussed about individual futures contracts. We discussed briefly and touched upon options on commodity futures. And there is something known as index futures. So when we talk about index, it's easily relatable to the existing equity indices like Bank Nifty and the Nifty itself, right? So in a similar fashion, we have commodity index futures. Broadly, we have Bulldex as the bullion index, the metal dex as the metals index, and energy dex as the ENRG dex symbol which is available for trading. So bullion index comprises of 64% of gold, 63.70 to be precise, and 36.30 of silver. So what these percentages mean is any change in price, percentage change in price. Percentage change means if the gold yesterday was 50,000 and today is 50,500, which is 1% change. 1% change multiplied by 64%, there would be a change in the price of Bulldex. 1% change in silver multiplied by 36% of it will have a price impact on Bulldex. So if the price of gold and silver moves in unidirectional movement, you could see the value of index also changing. Since gold has the maximum weightage out here, you can fairly assume that any significant index, which is the Bulldex, and you can easily take advantage of trading the Bulldex contract. For energy index, crude oil is 51% weightage and natural gas is 49% weightage. For metal index, we have copper having roughly 40% weightage, nickel having 25% weightage, followed by zinc, aluminum, and lead. So any trade, from trade perspective, if you want to trade metal index, any changes in prices of copper and nickel, which constitute 65% of the value, you can easily take your trading decision in the metaldex contracts. So the Bulldex, metaldex, as well as the energy index, these are the cash settled indices. 1 unit of Bulldex and metaldex is 50 units or 50 times. The contract value is approximately 7.5 lakh to 9.5 lakh for Bulldex and metaldex. And energy index is 125 times, which means that the contract value is roughly 8.5 lakh rupee at a margin or at an index value of 6,800. One tick change is 50 rupee in case of Bulldex and metaldex, and for energy index, one tick change is 125 rupees. Margins, as I showed you previously. The contracts are 3-month contracts available. Most important, these are the cash settled contracts, which means even if your position is open on the last trading day, it gets cash settled at 5 o'clock. The position limits for individual clients of 1,000 lots or 5% of the market-wide open interest, whichever is higher. That's a good number to start with. So when I extrapolate these changes in Bulldex, metaldex, and energy index to Nifty, you can easily say that there is hardly any correlation between Nifty. If you see the extreme left-hand side table, the correlation of Bulldex to Nifty is negative. Correlation of metaldex to Nifty is 0.14 and energy index is 0.18. In commodities market, if a correlation is 80-85% and above, it can be fairly assumed that you can trade easily. But in case of any correlation below 75%, which means that that product is on its own, it trades differently to Nifty, it trades differently to other products, right? So this is the reason, another example why there is a case for investors to consider commodities trading in their portfolio, right? Because having a low or a negative correlation to the benchmark Nifty index. So these are lots and lots of information available on the exchange website, on our YouTube channel, on our social media channels, a lot of information on our website, which can be used by you to gain more information on what commodity derivatives are and what are the products traded on the exchange platform. So this was a short presentation from my side. Thank you so much for hearing me out. If we have any questions, we'll take it forward later. Thank you so much.
Thank you, Sumesh, for that very lucid presentation on commodity derivatives. It was indeed a very nice presentation. And the way that you explained why trading commodities, highlighting about diversification, liquidity, transparency, it was really, really wonderful. We have understood about the commodity as a product. So I have my colleague Pankaj Agarwal, who is the product manager for commodities and currencies at ICICI Securities. He'll run through the website and he'll just highlight where all you have great content about commodities, what an wise investor or a trader who comes into commodities should look into, and then trade in current commodity derivatives. So Pankaj, over to you.
Thank you, Ramesh. So participants, I'll take you through our website where you can get information where you can trade and some other relevant information which you may need during the course. So I hope my screen is visible and my voice is coming clearly to all. Thank you. Okay. So this is ICICIdirect.com, the first homepage. Over here, this section called commodity. Click here. Why I'm coming here? Because we can straight away go to login and can check how can you place an order. But prior to it, it would be worth to understand some other relevant information before placing an order. So this is markets page, default page. When you click on the commodity, here you will get some information regarding high, low, open interest, and price which is currently running. A graph will also come. Currently it is not coming, but when you come to this page, you will get the graph also. And below to it, very important piece of information, that is calculator. So what would happen when you wish to take a trade in commodity? Then you need to understand what is the amount that you would be incurring. So there will be two aspects to it. One, that you pay to your broker, that is ICICIdirect in this case. Second, the charges that are additional to it. Now, for example, if you wish to trade in gold, and gold, that is 1 kg. Now you have an option to select different varieties of gold contracts that are available for trading at an exchange. As Sumesh has explained that in gold there are 4 type of contracts, in silver there are 3, and likewise here you have an option to select different contracts that are available for trading at ICICIdirect currently. So in case if you select gold, then you have 4 options: gold, gold guinea, gold mini, and gold petal. So all these gold contracts are different quantities. Now, suppose if you intend to take gold, and whatever is the price that is running, that would appear here, or you can change as per your own wish also. For example, if the buy price is 52,099, right? And if we say, if you buy at 52,099, and if you sell at just 1 rupee up, say 52,100, then what would be the impact? And if you take only one lot, see, remember, gold 1 kg is equal to 1,000 grams. And when you trade in gold, the quotation unit is 10 grams. That is price changes per 10 gram. So if there is a movement of 1 rupee, it would mean that the movement is happening per 10 gram. And you can easily find the multiple. If you trade in gold, what would be the multiple? 1,000 grams divided by 10, that is 100. So for any rupee change, for any tick size change, the impact on gold contract would be of 100 rupees. Now, when you take gold position, then it will give you the total buy and sell value, and you get the brokerage amount. At ICICIdirect, we charge only rupees 20 per order, irrespective of lot sizes. So whether you wish to take 1 lot per order or 100 lots per order, it would be rupees 20 only, buy side and sell side. Apart from that, there would be additional charges also, which would be taken by exchange, that is MCX, SEBI, then of course GST payable to government, and a very draconian tax called CTT, Commodities Transaction Tax. Now, if you look here, the breakup of all these charges, now total expenses that you would be paying is around 1,000, but if you look at the breakup of these charges, 50% is around 523, which is of CTT, right? So don't be afraid that we are not charging you 523. We are charging only 40. So this gives a clear indication. So we are on the safe side. Now look how much you need to achieve a break even, because any trader, when they want to trade in any commodity or for any underlying, they always want to know that how soon they can achieve the break even. But from this calculator, you can easily find how soon you would be able to achieve break even. So of this 1,000 rupees for 1 lot, the movement would be what, 100 rupees, right? So it would just need 10 rupees to achieve the break even, because for every 1 tick, there would be a movement of 100 rupees approximately. So you would need to have 10 rupees movement to achieve the break even, so that you can achieve the cost at least, and anything beyond that will give you the profit. Likewise, on the right hand side, there is a calculator whereby you can achieve, you can find the break even or profit or loss. So that may happen in case if you wish to take a trade in any of the indices. And now we know there are 3 indices available for trading: gold DEX, energy DEX, and metal DEX. Likewise, you can calculate the values for 3 indices here. Below this, some other relevant information means what is the high and low for any commodity in terms of price and in terms of volume trading. and some news that are relevant to help you to take decision, because in case of crude oil and natural gas, a lot of information is available, and that comes from overseas market like US and Europe. And that basically can help you decide that should you trade in any commodity or not, because inventory level, then geopolitical reasons, etc. We keep all those information and news keep on coming here. Now, next to it is the page, which is a product page. This is again very important page in terms of information and knowledge information, basically. See, in the markets page, you will come to know about the prices. You will calculate the break-even point or the price or profit loss. But in addition to it, one would always be interested that how can one can know more about any product, say gold or silver or crude oil or something like that. So here at this page, we have given some very relevant information. You can start with reports. Now, these reports are provided by our research department. So on daily basis, research report comes on commodity, weekly, monthly, and some special reports of course come whenever there is any special event or whenever research department feels that our investors and traders should get some more information about commodities market, then they keep on providing the special reports. So in daily report, if you open, you will find a PDF, and you can find all the research calls that are the research department keeps on giving on daily basis. See, remember, this research report comes once in a day, but if you go to our website under I click to gain, you will find all the research calls which keeps on coming during the trading window, which is available for trading in commodity, which we will see later on. So just to give a glimpse of what is available in daily report, I've clicked on that. Apart from that, we keep on populating articles, relevant articles under commodity. Now here you can see different articles which are coming up front, and if you scroll to the right hand side, you will find more articles coming here, and likewise. So our endeavor has been to provide all those articles which could be of use to investors and traders, and to understand more about different commodities, see portfolio diversification. So if somebody wants to know why should one trade in commodity market, well, Somesh has given very clear answer to it, or he has explained very well. But still, somebody wants to read more about it, then this is an article which could be referred. Crude oil and natural gas, see, these two commodities are of interest lately. So in the recent 3-4 months, because there has been quite upheaval in crude oil and natural gas because of some events lately, one can read what could be impact of those things in general on the prices, and how could things in crude oil and natural gas effect on pricing and trading. Likewise, very interesting videos. So you just keep on scrolling and you'll find a lot of information, piece of content here. Just keep on scrolling, you'll find the information on different commodities, and you have a filter here which can again be useful to find which type of video you want to look at. For example, you just want to have a glimpse of a very short video, 1 or 2 minutes video, which can be of use to, just to get a quick overview of different commodities or about different processes. Or if you want to have a deep understanding about different commodities, these are the videos which our segment head, Mr. Ramesh Vedkar, has recorded with M6 people, and in detail, basically things have been covered here. So we request you to go to all these pieces of content and enrich your knowledge about commodities market. Of course, that will help you in trading process. Similarly, podcast, what you can hear on the go, means in case if you feel that you are busy but still want to continue keeping or taking information, you can switch on to podcast and FAQs, of course. These are some of the important FAQs which you have to put here. We have assorted some FAQs and put it over here. So these FAQs can help you on some very important aspects, means what are trading hours, of course you would be knowing, but still you may not be aware what exactly are trading hours, because most of you would be habitual of trading in equity markets, say 9 to 3:30. Then of course then you may feel that okay, now trading in commodities will also be till 3:30. No, it's beyond that. So it's till 11:30 during 7 months of a year, and till 11:55 for rest of the 5 months in a year. So this is all about what you can access on commodities market before login, and of course while login also, but before login, this is. Now I come straight to the trading part. I hope my voice is coming clearly. Okay, thanks. So when you will log into ICICI Direct, there is a possibility you may straight away come to the commodities homepage. So in case if you come to say equity, you can come to the commodities homepage by clicking on commodities tab at the upper ribbon, and then there are number of options available at the lower ribbon to it. Place order is the page where you need to go, and some of the traders or participants may like to know that what all commodities are available for trading, right? So if you want to place an order, though you know that there are different commodities, but all commodities are actually available, just go to commodity list. You will find all the commodities that are available for trading currently at ICICIdirect.com, right? Now, these are the codes, underlying assets name, lot size, and action. Action basically means that you can calculate margin, because before you start trading, two things you need to do. One, that you need to allocate funds in your commodity segment. And secondly, you need to know how much margin would be required, right? So before you allocate funds, you would need to know how much margin you need to put in your in the commodity segment. Now, suppose if you intend to trade in gold, I come here, view margin. Now, view margin could be checked from that page as well as straight away from this page also, margin calculator. This will show the same form to calculate margin. Now, currently futures are available for trading, so it will show futures. As soon as we will introduce options, it will show an option for the option feature to select options also. Just type the code gold. It will drop down all the available contracts: gold, gold guinea, gold metal, and sorry, gold mini and gold petal. Gold. You need to select an expiry date, because of the total 4 contracts available in gold, 2 types of gold contracts expire every month, the last working day: gold petal and gold guinea. But 2 other gold contracts, gold 1 kg and gold mini, they basically run for once in 2 months, means the expiry is once in 2 months. So if you click here, you will find that in case of gold 1 kg, the expiry is the number of contracts available are of 2 months. That is, current expiry is of 3rd June and the next expiry, right? So at ICICI Direct, we open only those contracts which are liquid in nature. The third expiry may be available by the M6, but we usually do not open, because if there is no liquidity, it doesn't make any sense, because in that case, you may not be able to find the best price for your trade. So you simply click on here, add, and you will find the margin requirement for gold 1 kg. So whatever price is currently running, or if you wish, you can change the price here. But suppose if it is 52,094 rupees per 10 gram, then the margin requirement will be around 5 lakh, 12,000. And similarly for other commodity, you can select for other. For example, if I take crude oil, just select the expiry. There is 1 contract available only, 19th of April, and add it, and you'll find total margin required for the crude oil 1 lot. And accordingly, if you intend to buy 2 lots, 3 lots, and so on, keep on multiplying, you will get the total margin requirement. Now, next important thing would be buy or sell. Now, there are 2 ways. You can come to the buy and sell from here, or you can come to the place order and can do the same thing. Now, for example, if you intend to buy crude oil, then you can see that straight away place order, it has come to place order with some pre-populated information, right? Crude, you can, from here also, you can select the expiry months, 19 April and 19 May, and you can select from here buy and sell. See, in crude, 1 lot, it is of 100 barrels. So we have an option to put either of the values. You can select 100, or you can select as per lot also. So if you are selecting as per lot, you have to toggle between these two, quantity and lots. And if you click on lots, then you have to put the lot value. Please remember, it is only per lot. In gold, it is 1 lot is equal to 1000 grams. In gold petal, it is 1 lot is equal to 1 gram. So if it is 1 gram or 100 grams, you need to put grams over here. In case of crude, you have to put 100 because one lot is equal to 100 barrels. So you have to choose either of the options here. Suppose if you are comfortable with lot size, you check on the lot, and then you have an option to place an order either at the market value or at the limit value. Suppose if the current running price of crude is 7,365, you can click on the market and it will go as per the market price, right? So this is the verification page, and if you click here at the proceed, if there is no fund, if there are no funds available, it will ask for the funds. Market orders can be placed only when the exchange opens. Since today is Saturday and the exchange is not open, so it hasn't shown the page where you would need to allocate funds, but it will show the page or the pop-up that you need to allocate funds before you come to place an order in commodities section. And this is the place, or this is the funds allocation page. I think most of you would be aware about it. Those who would be trading at ICICIdirect would know how to place order and how to allocate funds. Still, for the benefit for the larger audience, I'm just giving a demo of it, how could it be done. So whatever amount is there in your bank account, that would reflect here, and you need to first transfer that amount to here from to trading account. Suppose if my account is 48 rupees, if I transfer 1 rupee, it will first come to the trading account. Now this trading account is a generic trading account. From here, you need to allocate fund to different segments, to commodity, currency, and so on. Suppose if I intend to transfer 1 rupee to my commodity account, I need to click here. Then 1 rupee would be available in my commodity segment. And from here, sorry, I think I put it in the currency segment. I put 1 here. Okay, so since there was only 1 rupee, I need to allocate 1 more rupee. I'm just giving a demo, the amount could be different just for the sake of purpose that you understand it. Now I transfer 1 rupee to commodity. 1 rupee would be transferred to the commodity segment. Now here you can see 1 rupee has come to the commodity. Now you can trade because funds should be available in commodity segment. Okay, now this is the process. And once you have mark to margin profit, or if your position is squared off, then you will find amount getting populated over here, and then you can reduce the amount. It will firstly go to trading account, then you need to transfer it back to your bank account. Please remember, you need to do 2 steps to transfer the funds to your segment, desired segment, from your bank to trading, and trading to desired segment, and similarly reverse. Okay, now if you go to place order form, you would be able to place the trade. And once you place a trade, firstly, it will come to the order book, right? Now, in case if it is market order, it will straight away get executed because whatever price would be running, it would get executed. But in case if you have placed an order at a limit price, now here is an option to place an order at a limit price also. Now, suppose if I type gold, and you can select which gold contract, gold Guinea or gold 1 kg, it will show all the available contracts. As per your desire, you can select buy or sell. See, it would get activated, right? Suppose if I type 1, if it is 52,094, you want to place an order at a price which is favorable to you, then you can choose price lesser than that. For example, 52,000, and the order would be executed at the limit price, right? So then when you proceed, again, it will show the same thing, that exchange is not working today, so you won't be able to place it. Otherwise, if funds are not sufficient, it will show the populated form, this allocate funds order form. Okay, now in case if it is a limit order, in case your order is not executed, it will continue lying in the order book, because any order which is not executed at the exchange level will continue coming here in the order book. And it will go in the trade book only when the desired price is achieved, right? And once the desired price is achieved, it will come here in the trade book, it will go away from the order book, and then you would be able to see what is your open position. The open position will show all those things, all those orders that have been executed. Also, all those orders which are still not executed at the limit because of limit price. So this open position is very useful page because it will show a lot of information that you would need to know. What is the trigger price, what is last trading price, then what is the margin that you would have allocated, minimum margin, and so on. Now, there are 3 things: block margin, minimum margin, available margin. What are these? And just try to understand by way of example. For example, you have to place an order of gold 1 kg, and you have allocated margin of say 5 lakh rupees, just for the understanding in round figure. Now in ICICI Direct, slight percentage of markup is taken. So say it could be like 5 lakh 15,000, right? Exchange requirement is 5 lakh, but in markup is taken over the required margin, just to safeguard the position of a client as well as of ICICI Direct. Now 5 lakh 15,000 would be the margin that you would pay initially. Now with this would be called the initial margin, and below to it would be like 5 lakh 10,000. So it would be minimum margin. The minimum margin is the amount that you would need to hold or continue to hold till your trade is live. So in case because of price movement, say if the price comes down from 50,000 to 49,800, then there would be a loss on the position. So that amount will be deducted. And again, our system will calculate what would be the minimum margin. And if the minimum margin comes down below 5 lakh 10,000, then it will first try to find, are there any funds available in your trading account or commodity segment? So if there are no funds available in commodity segment, that means that your available margin is lesser than minimum margin, and your position would get squared off. So what would happen if you have taken a position, and if you're taking a situation that shut it and forget it, then it will not work. You need to continuously look that what is the available margin and what is the minimum margin, and then only your trade will continue as per your desire. Other way could be that you allocate more funds in your commodity segment, and in case if it is a requirement of some additional margin by our risk management system, then it can pull the required funds from there. Or there is one more feature where if you have taken a trade, then you can actually add margin to your existing trade also, modify margin. Now let's take a situation if you have taken 2 trades. Now, in case you have taken 2 trades, if you add additional margin by way of modifying margin to 1 trade, it would be good only for that trade. But if you allocate the additional margin commodity segment, then it would be good for all the trades that you have taken, that is for the entire portfolio. Now, since we have spoken about portfolio, we come to the portfolio. In the portfolio, there's a filter of different dates and calendar. So you can check for which period you want to select the portfolio, for which period you want to have a look of your portfolio. And then it will show all the running trades. For example, if you have taken 2 trades of gold, 1 trade of crude oil, 1 trade of natural gas, then it would be grouped. In open position, they would come, in a discretionary way, means 1 by 1, 1, 2, 3, 4, 5, 6, not in group manner, but in portfolio, they would be coming in a group manner. So overall profit or loss for that group would be displayed here. And from here, you can see what is the profit or loss. Similarly, in open position also, you can check what is your profit or loss for a given trade. Now, some important information, because we say that you trade at our platform, but why should you trade at our platform? One, it's a seamless platform. You won't find any difficulty while you trade at ICICI Direct. Things are very intuitive, means when you can calculate margin requirement, you can transfer your funds to trading account to different trading segments. You can transfer, you can withdraw the amount very easily. Also, it doesn't take much time compared to other brokers. So these are the key features that are there in ICICI Direct. Apart from that, very key feature is I click to gain. Now in I click to gain, you can find all the research calls that are available under the commodity segment for different commodities. You come here and you can select commodities, say here commodity futures, and whatever calls are provided by our research department during a trading window would come here, and you can take a decision basis that. Our research performance has been quite good, has been very encouraging. In commodity segment, it is actually around 70%, and our historical performance actually is more than that. So how can you, take advantage of all these things? By coming here and by checking it regularly. This would be one very good way of taking advantage of ICICIdirect.com. So I think these are relevant information which you may need to have when you trade at ICICIdirect.com. I think now we can open the floor for the question answers. If you have any, please type in the chat box, or you can open.
Pankaj, one point, if at all, you can just show the participants where our presentations are, so that they'll be able to refer it in future.
Sure, sure. So all our presentations which you use, you need to come to the commodity page. You simply click on commodity wherever you are. If you click on the commodity, this page will open, and you can find information, that daily podcast which comes. Daily podcast means at the morning, our research department records one podcast, and they record their view on different commodities. This is very useful piece of information. You can check it from here. I click to gain what we check from that link. You can click here. You can get you can access I click to gain from here also. And then presentation is here, commodity presentation. Basically, if you open it, then a PDF would get opened. You can see PDF getting open here. And this PDF basically provides all the relevant information, which Sumesh basically has explained very well in his presentation. In a second manner, in a very short and crisp manner, we've also tried to put it over here. So you can refer this presentation to enhance your understanding on different commodities. And this is a very useful piece of information which you can refer. So this is all. And if you have any query, you can always write at this ID, helpdesk@ICICIdirect.com. Yeah. So we cannot take questions from the participants.
Yeah, Pankaj, there is one query from Mr. Just a second, I will check. Mr. Nandan. Can I place stop loss and profit order both together at ICICIdirect in commodities?
Okay. So at ICICIdirect, you can place stop loss and profit order also, but not at the same time. So a stop loss would mean a cover order. If you have taken a position in any commodity, you can put an opposite trade by modifying it, by squaring it off. When you square it off, you can put a stop loss, or you can place a profit order or target order, but not at the same time. A bracket order functionality is not currently available in that case.
Thank you. I think most of the queries has been answered by Mr. Ramesh Varkhedkar in chat room itself. So
yeah, I tried to answer as many questions as possible. Again, there's one more question from Mr. D. Saha. When will be brokerage zero like other platforms? Mr. Saha, as I also replied on the chat, saying that currently the brokerage is only 20 rupees per executed order, irrespective of the lots or irrespective of the value. So currently it's pretty small, which is just 20, and there are no other different slabs as of now. So it's only one brokerage across ICICI securities for commodity derivatives, and that is rupees 20 per executed order. And my colleague Pankaj also showed you the brokerage calculator. You can just put whatever your trades are at entry and exit price and see where the break-even will come. So the brokerage is just 20 rupees per order, and it's a very small component. I hope I answered your question.
I think, sir, one question is for Somesh. Somebody has asked in beginning, why not commodity markets open for 24 hours? Right? It is almost 15 hours. So Somesh, in case he can.
Sure. So presently we are limited to that timing of 9 a.m. to 11:55. But as you see in the international markets, the markets are open for 22 hours. I mean, when we are sleeping, the Australia and Japan and Singapore open. Then the Indian market opens, and then the European markets, and then the US markets. So it's a 24-hour market actually for commodities with basically 2 hours break independently. Yes, in future there is a scope for extended market hours, but then we also need participants who are there for 22 hours to trade commodities, right? I mean, yes, there are participants who are watching commodities closely, but as of now, it's an already a 16 or 14-hour market in India. Let's hope that something can be worked upon in future when we have more production participants.
Yeah. Thank you, Somesh. I hope Mr. Farhan is convinced with the answer. Okay, I think we don't have any more questions.
Okay. I know it's been almost 1 hour. I think the discussion and the presentation was useful and it will help our investors. So thank you, Somesh. Thank you for joining us today and sharing the presentation. Thank you, Pankaj, for giving the insights and how to trade and also show all our customers where those videos are. So whatever is being presented, those presentations are available on our commodities page. And also there are small videos which are there, why to trade commodities, how to trade commodities. There are different blogs which will be helpful to all the participants to participate in commodity markets. So thank you once again for joining today's session. Thank you.
Yeah. Thank you so much, sir. Thank you, everybody.